Good evening, everybody, and welcome. On this day after that historic rally in the markets, sparked by the Federal Reserve's decision to begin winding down its economic stimulus measures, stocks struggled to hold on to those hard-won gains of yesterday, but some of them did. Trading remained in a pretty narrow range all session long, with investors shrugging off disappointing data about jobless claims and existing home sales. But the Dow did gain just enough to reach another all-time closing high, now on track for its best week in 3 months. Here's how the major averages ended the day. Take a look. Those blue chip Dow stocks up another 11 points. NASDAQ, though, fell about a dozen, and no new record for the S&P. It was down by a point today. The Fed's decision to taper its bond buying, which sent the U.S. dollar higher, sent gold prices lower, with the precious metal settling at a more than 3-year low, down more than $41 an ounce today.
So what does the taper mean for stocks, treasuries, gold, and oil? The Fed's pullback in its bond buying program is affecting investments in just about everything. It's also impacting stock sectors in different ways. Jackie DeAngelis takes a closer look.
A day after the Fed's announcement that it's tapering its asset purchases, the yield on the 10-year Treasury note is on the rise. While many traders don't expect yields to spike too high in the short term, estimates are for between 3 and 3.25%, there is a potential to see steeper hikes as the Fed continues to wind down its QE program. That's why right now, this wait-and-see period might be the time that we see investors move out of some sectors and into others in a market rotation. Certain sectors are especially sensitive to interest rates. Those are the ones that could suffer in the next 3 to 6 months. Sectors like telco, utilities, consumer staples, and healthcare. These groups can be rate sensitive for several reasons, namely because they have to service debt and also because they pay dividends, which means that they become less attractive to investors when higher rates can be had with less risk. But on the flip side, one of the big winners of the taper news, the banks. They'll use the rise in interest rates to their advantage.
The Fed isn't changing the rates on the short-term end of the scale, so they'll keep those relatively low, and yet mortgages rates are going up. So that will create a bigger spread for the banks, which is good news for mortgage lending.
Rising interest rates also help sectors with pricing power, like the materials, industrials, technology, energy, and consumer discretionary groups. These tend to be more cyclical and perform well when the economy is growing, which makes them less susceptible to rate fluctuations. They also tend to have lower dividend yields. But that's not to say that there's no risk.
Twice before, they started to wind down QE. Twice before, they had to ramp it back up because the economy stumbled. We're not out of the woods. This is still very much a job that Janet Yellen has to finish.
Of the sectors that can benefit from the rotation, energy has been an underperformer, and analysts see opportunity there. They're looking at names like big oil companies, Exxon and Chevron, also the service stocks like Halliburton, Schlumberger, and Baker Hughes. For Nightly Business Report, I'm Jackie DeAngelis.